Imagine Oprah endorses a new investment, promising 10% monthly returns with zero risk. Thousands of her fans invest because they trust her. Early investors actually see returns, but those profits aren't coming from real investments. They're coming from new investors' money. Now, imagine LeBron joins in and tells his fans it's a can't-miss opportunity. Even more people invest. The scheme keeps going as long as new money keeps flowing. But the moment people stop joining, it collapses, leaving everyone except the early few with massive losses. This is a Ponzi scheme in action. For more than a century, these promises have pulled in millions of people: ordinary workers, wealthy families, celebrities, banks, even entire governments. From Wall Street to communist Romania, the same pattern has repeated again and again. A select few rise to unimaginable wealth, while millions lose everything they've worked for. These are the largest Ponzi schemes in history. Let's start from the smallest Ponzi schemes and move to the biggest. In the early 90s, a newly free Romania was hungry for hope, and promises of wealth flooded in. The communist regime had just collapsed, the old institutions were crumbling, and inflation was swallowing people's life savings. Into that chaos stepped a miracle, or at least, that's how it looked. One scheme convinced millions that prosperity was finally within reach. Just deposit money, and within months you'd get back 8 times what you put in. This was Caritas, the scandal that drew in up to half of Romanian households. It wasn't just fraud, it was a national fever. Founded in 1992 in Cluj-Napoca by accountant Ioan Stoica, Caritas branded itself as a mutual help game, which had the purpose of helping impoverished Romanians during the transition to capitalism, and promised 8 times the money invested in 6 months, tempting many desperate Romanians just after the fall of communism. But, in reality, it functioned exactly like a Ponzi scheme, promising astronomical returns paid by the money of new depositors. Ioan Stoica, a modest accountant turned mastermind, knew exactly how to exploit trust in a country that had just left communism. He presented Caritas not as a shady gamble, but as charity, a way for communities to help each other. That framing made the scheme feel morally acceptable. Millions of Romanians, from rural peasants to city workers, trusted it. Some reports suggest as many as 35 to 50% of Romanian households had cash tied up in Caritas at its peak. As long as people kept joining and depositing, Caritas paid out big returns. To appear legitimate, they regularly published winner lists in the newspapers. People believed they had real, repeatable payout days. But, behind the scenes, the model depended entirely on new money flowing in. Without it, the whole thing would collapse. The twist? Political cover. Caritas prospered with the help of the connection it had with the nationalist Romanian National Unity Party and the mayor of Cluj-Napoca, who welcomed this scheme and even helped it build credibility by renting them space in the Cluj town hall, appearing with Stoica in public and on television, and defending Caritas from attacks. Public endorsements and media hype made people believe Caritas wasn't a scam, it was a legitimate financial movement, helping Romanians thrive in a new capitalist era. In late 1993, things began to crack. Payouts were delayed. The authorities warned of fraud. By August 1994, Caritas went bankrupt, leaving behind a massive hole. Stoica was arrested and convicted, but his prison sentence was short. He served just a fraction of what many thought he deserved. Caritas left a permanent scar on Romanian society. Some say it held a third of the country's cash supply at one point. Caritas wasn't just a scam. It was a lesson, and in the end its debt was estimated at $450 million, or $955 million today. Imagine a cryptocurrency promising 40% returns per month with a system so automated you didn't have to do anything. Sounds like a dream, or a nightmare waiting to happen. Welcome to BitConnect, the crypto Ponzi that stole over $2.4 billion from investors worldwide. Launched in 2016, BitConnect looked like a legitimate cryptocurrency exchange. It had charts, wallets, referral programs, and a native token, BCC. It promised profits based on a mysterious trading bot that could beat the market daily. Within months, thousands of investors were pouring in their savings, believing they had found a revolutionary new way to make money in crypto. Here's how it looked on paper. Investors bought BCC tokens, then lent them to the platform. The algorithm, supposedly an AI trading bot, would trade crypto automatically, generating massive daily returns. They advertised up to 1% daily compounding over time, enough to double or triple your investment in months. The platform also had a referral program, recruit friends, and you earned a cut of their profits. which meant early investors were paid not from trading, but from new investors. Classic Ponzi mechanics dressed up as a tech miracle. The twist? There was no AI. There were no legitimate trades producing consistent 1% daily returns. All the profits came from new investor deposits. As long as fresh money kept flowing, the system looked unstoppable, and it worked until it didn't. Despite warnings from regulators and cryptocurrency experts, the hype and fear of missing out drove people to invest millions, sometimes their life savings. On November 7, 2017, the government of the United Kingdom issued BitConnect a notice with 2 months to prove its legitimacy. On January 3, 2018, Texas State Securities Board issued a cease and desist to the company, calling it a Ponzi scheme and citing failings in user earnings transparency and misleading statements. On January 17, 2018, BitConnect shut down, and BCC prices crashed by 92% immediately after. BitConnect's platform immediately shut down its lending program. Token prices crashed overnight. Investors lost almost everything. The total estimated losses? $2.4 billion. What if someone told you they were buying millions of dollars worth of electronics, but the warehouses were empty, the shipments never arrived, and the invoices were fake? That's exactly what Tom Peters did, orchestrating a Ponzi scheme worth $3.65 billion. Peters was a Minnesota businessman who promised investors huge returns through the purchase and resale of consumer electronics to major retailers like Costco and Best Buy. He was polished, confident, and seemed completely legitimate. A self-made billionaire living the American dream. Here's how it worked. Peters claimed to buy electronics at wholesale prices and sell them at a profit to big box stores. Investors were told their money was funding real high-margin transactions. In reality, there were no products, no shipments, and no sales. Every dollar of profit paid to earlier investors came from new investors' funds, creating a multi-billion-dollar illusion of a thriving business. Peters didn't just lie. He industrialized the lie. His team produced fake purchase orders supposedly from Costco, forged shipping documents, fabricated warehouse records, and entire paper trails for products that never existed. They even staged warehouse tours to make the operation look real. Visitors saw pallets and paperwork, but none of it actually matched any real transaction. It was a fraud built on printers, spreadsheets, and confidence, a multi-billion-dollar illusion made out of paper. Peters kept up appearances for over a decade, living in luxury, giving speeches, and cultivating the image of a successful entrepreneur. Peters' scheme didn't stay small. It exploded because hedge funds helped pour gasoline on it. Major funds like Lancelot Investment Management, Palm Beach Finance, and Polaris funneled hundreds of millions into Peters' fake deals. Their managers earned huge fees by bringing in investors, and some of them, like Gregory Bell of Lancelot, even lied to their own clients about where the money was going. These feeder funds gave Peters something priceless: legitimacy. If a hedge fund believed in him, why wouldn't everyone else? Tom Peters didn't dress like a scammer, and he didn't buy scammer toys. He bought companies, real ones. Peters Group worldwide owned or controlled big recognizable brands: Sun Country Airlines, Polaroid, Fingerhut, Red Tag Media. Owning real businesses gave Peters an aura of credibility. If someone owns an airline and Polaroid, they must be legit, right? Because nothing says trustworthy like running an airline and pretending to sell fake electronics at the same time. Tom Peters didn't get caught because investors woke up. He got caught because his own vice president turned him in. Her name was Deanna Coleman, and after years of helping produce fake invoices and forged documents, she realized the whole thing was spinning out of control. One day, in 2008, she walked into an FBI field office, alone with a folder full of evidence. Over the next 2 weeks, she wore a hidden wire recording Peters as he casually admitted the entire scheme. Those recordings became the backbone of the federal case. Coleman wasn't just a witness. She was the person who detonated a $3.65 billion bombshell. Thousands of investors were wiped out, losing their life savings. When the Peters empire collapsed, the fallout was brutal. Sun Country Airlines went bankrupt, Polaroid was liquidated, trying to claw back whatever they could. Most victims got pennies on the dollar. Peters was convicted on 20 counts of mail, wire, and bank fraud in 2009 and sentenced to 50 years in prison. Beneath the sunny beaches of Antigua, a self-proclaimed billionaire promised investors paradise and massive returns. But behind the luxury yachts and lavish mansions, Alan Stanford was running a multi-billion-dollar scam. Before the yachts, before the private islands, Alan Stanford was nobody. Born in Texas, he bounced between mediocre business ventures, a gym that failed, a home-building company that couldn't stay afloat, and various side hustles that went nowhere. Stanford wasn't a financial genius, he wasn't even successful, but he was ambitious, obsessed with appearing wealthy, powerful, and important. And whenever one business collapsed, he simply rebranded himself and started another. In the early 1980s, he moved to the Caribbean, hoping to outrun his debts and reinvent himself. He brought along his father and brother, using them to help operate small companies and lend credibility to his new empire. Stanford claimed his company, Stanford International Bank, offered high-yield certificates of deposit, safe, conservative investments that would outperform any US bank. Alan Stanford didn't just run a bank in Antigua, he practically ran the country. He donated millions to politicians, funded cricket stadiums, built roads, schools, and public facilities, and in return, Antigua gave Stanford something priceless: total freedom. Regulators looked the other way. Auditors rubber-stamped whatever he wanted. His bank faced almost no oversight. Who audited it? Not Deloitte, not KPMG, not EY. The auditor was a tiny two-person accounting firm located above a fish and chips shop in Antigua. No one verified the investments. No one checked the assets. They just printed whatever Stanford told them, and that's how the fraud stayed hidden. Stanford didn't hide his fraud from the government, he owned the government. That's how an $8 billion Ponzi scheme survived for 20 years. Investors from around the globe trusted him. Celebrities, politicians, and ordinary people handed over their savings. The mechanics were simple but clever. Stanford promised returns of up to 13% per year, guaranteed. Early investors received their interest, giving the illusion that the bank was legitimate and thriving. In reality, the money wasn't being invested at all. Instead, Stanford used funds from new investors to pay old investors, maintain appearances, and fund his own extravagant lifestyle. Over the years, he secretly took more than $2 billion in personal loans. He used investor deposits to buy yachts, private jets, mansions, multiple islands, sports teams, and a global lifestyle of luxury. The twist? Here's the scandal within the scandal. The SEC received complaints about Stanford in 1997, 12 years before the collapse. One investigator wrote, "Stanford's returns are impossible. This is a Ponzi scheme." But internal politics, turf wars, and indecision caused the investigation to stall. As the SEC fought internally, Stanford kept growing more investors, more money, more countries. In 2009, the SEC finally shut down Stanford's operations. Investigators discovered a 2-decade-long Ponzi scheme spanning 136 countries. Stanford was convicted in 2012 and sentenced to 110 years in prison. Thousands of investors lost everything. Over $8 billion of investors' money had vanished. In the chaos of post-Soviet Russia, millions were desperate for hope and for cash. After the collapse of the Soviet Union, Russia was in freefall. Hyperinflation wiped out savings. Banks failed every week. Millions of people went unpaid. Trust in government and financial institutions was gone. Into that void stepped Sergei Mavrodi, a mathematician with a plan to get rich and make everyone else believe they could too. Mavrodi founded MMM, a company promising astronomical returns to ordinary Russians who invested in its stock. Slogans like "We can do anything" plastered cities, TV ads, and newspapers. Mavrodi didn't rely on simple ads. He created a media spectacle: billboards, glossy magazine spreads, TV commercials, and a fictional everyman, Lenya Golubkov, whose face became instantly recognizable. Lenya's slogan, "I'm not a freeloader, I'm a partner," became a national catchphrase. People lined up at offices, inspired by the mascot, feeling part of something bigger than themselves. It wasn't just a company, it was a cultural obsession. Mavrodi controlled the price entirely, publishing weekly updates in newspapers and on television. Every week the shares seemed to climb higher, doubling, tripling, quadrupling in value. Families watched the numbers rise and poured more money in, convinced they were investing in a legitimate financial boom. Meanwhile, no real business, no sales, and no revenue existed, just an elaborate illusion of growth. MMM paid returns to early investors using money from new investors, the classic Ponzi formula. At its peak, 5 to 15 million people participated. Families sold homes, cars, and even heirlooms to invest in the scheme. Mavrodi's promise of wealth was irresistible in a country still reeling from economic collapse. The twist? The Russian government attempted to step in. Investigators froze some MMM accounts and warned the public. But many Russians believed the warnings were politically motivated, that the state was trying to protect elites from ordinary people getting rich. This widespread distrust of authorities allowed Mavrodi to continue the scam almost unchecked for months. Even when officials tried to stop him, the people cheered the very man, defying them. MMM became not just a company, but a cultural phenomenon, a national obsession. After MMM collapsed, Mavrodi did something audacious. He ran for parliament and won. That victory gave him temporary legal immunity, shielding him from arrest. He used his new political status to continue operating in the shadows, manipulate supporters, and delay justice for years. It was one of the most brazen moves in modern financial crime history. A conman using democracy itself as a shield. In 1994, the scheme collapsed. TV warnings, newspaper articles, and occasional regulatory attention made people more anxious. Within a single day, millions tried to reclaim their savings, and MMM couldn't pay a ruble. Billions vanished overnight. Riot police clashed with angry investors. Dozens of suicides were reported. Mavrodi fled the country, evading authorities for years before being arrested and jailed. Even after his eventual prison sentence, Mavrodi relaunched MMM multiple times. He expanded to India, China, South Africa, Nigeria, and Latin America, and later to cryptocurrency markets. Each iteration promised easy money, astronomical returns, and legitimacy. Millions more investors fell for it. Mavrodi became a symbol, the man who turned math, media, and mania into $3.9 billion today. But due to how hyperinflated the ruble was back in the day, the range goes all the way to 80 billion, but we can't be entirely accurate. Imagine trusting someone so completely that you invest your life savings, your family's inheritance, even your charity's funds. Now imagine discovering that everything was a lie. This is the story of Bernard L. Madoff, the architect of the largest Ponzi scheme in history, $64.8 billion gone. Bernard Madoff started small. In 1960, he opened an investment firm with just $5,000 from family and friends. Early on, he built a reputation for steady, reliable returns. The kind of man everyone trusted with their money. He joined charities, prestigious organizations, and the Jewish community, carefully crafting a network of influence. By the 1980s and 90s, he was a Wall Street titan, chairman of the Nasdaq, advisor to the wealthy, and the face of competence and trust. His rise wasn't just luck, it was calculated. He promised steady returns of 10 to 12% every single month, no matter what the market did. Madoff claimed to use a sophisticated strategy, buying S&P 100 stocks and hedging with options. In reality, there were no trades, no hedges, just carefully forged statements showing constant profits. Clients received monthly account statements with numbers that never went down, even during market crashes. He ran the biggest investment firm in a basement, literally. He was like Breaking Bad, but with spreadsheets instead of meth. Maybe I should try it. For years, everything looked perfect on paper. The green numbers never stopped growing. The twist, Madoff's reputation made him untouchable. Auditors, regulators, and sophisticated investors assumed he was too smart or too well-connected to be fraudulent. Tips came repeatedly. Auditors were tiny and unqualified. Regulators received multiple warnings, including from whistleblower Harry Markopolos, but nothing changed. Even sophisticated investors ignored their doubts, seduced by Madoff's reputation, charisma, and prestige. It was a stark lesson. Even the smartest, richest people can be blinded by trust and greed. The longer it went on, the harder it became for anyone to imagine it could collapse. Bernie Madoff was disciplined, meticulous, and charismatic. He projected competence and security, qualities that reassured the richest and most skeptical investors. He exploited trust, prestige, and human greed, turning Wall Street's elite into unwitting victims. When the 2008 financial crisis hit, investors wanted withdrawals. Madoff couldn't keep up. The house of cards collapsed. Even Madoff's sons alerted authorities after realizing the truth, ending the decades-long fraud. Investigators discovered no trades, no profits, just billions of dollars missing. Clients who had invested their entire lives were left with nothing. Madoff was sentenced to 150 years in prison, more time than most of us could spend binge-watching Netflix, and died behind bars in 2021. His scheme ruined thousands of lives, from hedge funds and celebrities to Holocaust charities and retirees. It was the ultimate betrayal of trust, the blueprint for modern financial fraud, or as some call it, Monday morning on Wall Street. He tricked the smartest people on earth. And I can barely get my roommate to do the dishes. Trustees later recovered over $14 billion for victims, but thousands were left devastated. The case reshaped Wall Street, reforms in SEC oversight, hedge fund due diligence, and financial compliance followed. But Madoff, he walked into prison with a $65 billion fake paper empire. You can't say it's not impressive. From Caritas in Romania to BitConnect in the crypto world, from Tom Petter's electronics empire to Alan Stanford's Caribbean fantasy, and finally, Bernard Madoff's Wall Street illusion, the story is always the same. The promise of easy, guaranteed wealth seduces even the cautious. Charisma, spectacle, and trust can mask a complete lie. And history shows us one brutal truth. The bigger the promise, the bigger the fall. Ponzi scheme is like trusting your roommate to do the dishes, but they just move the dirty plates around and call it progress. Thanks for watching. If you found this insightful, hit like, subscribe, and stay tuned for our next deep dive into real estate's biggest players.